Alright, gang, it's your boy Nature, aka Nature. I already know what time it is. Back for another video. Like I said, gang, I'm teaching y'all everything on how to make market, how to make money in this market. You know what I'm saying? Anything and everything I can do to help y'all, do whatever you gotta do. You know what I mean? And it's, to get where you need to go to the next level in life. I got, you know what I'm saying? Like, this is like one of the ways you can have financial freedom. Yeah, I know I got y'all. I'm gonna give it all out to y'all. So, moving average. Alright, so we got the moving average. So what is the moving average? Alright, we went over all the trends, went over all the fundamentals. There's a few more things you gotta go over, like moving average, Fibonacci, RSI, price action, trend line. A few more things you gotta go over before I actually start showing y'all actual trading videos and stuff and showing y'all how to make money and like put it all together. You know what I'm saying? I just want y'all to understand all the basics first. So that way y'all know what y'all doing when y'all get into this market. You know exactly what you're doing. You know what I'm saying? From detail to detail. So that's why I'm doing it this way. And then another like a few more videos. We got a few more videos we gotta like, get out the way. That's really important stuff that you need to know about making money in this market. And then I'm gonna show y'all how I make it, how I do my trades and all that. I'm gonna give y'all everything. Alright, so first thing first, get moving average out the way. So what is a moving average? Alright, it's an MA, stands for moving average. Statistically, a moving average is the calculation used to analyze data points by creating a series of averages of different subsets of the full data set. Okay, so it calculates and analyzes the data points by creating a series of averages of different subsets of full data sets. In finances, a moving average (MA) is a stock indicator that is commonly used in the technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. So a moving average is a constantly updated average price that shows you, what price is doing, in a series of, over the full data for the last like 10 days, last 15 days. It'll show you they created a series of averages that, that add up. Help, it helps you create, it helps you make, so it can help you make your decision better. So by calculating the moving averages, the impact of random short-term fluctuations, by calculating the moving average, you can, calculate the impact of random short-term and fluctuations of the price of the stock over a specific time frame are migrated. So these are key takeaways for the moving average. Moving average is a stock indicator, okay? The indicator that we also use in Forex, using stocks too. That is commonly used in the technical analyst. So every technical analyst uses moving average. I can guarantee you about that one. I use moving average. So the reason for calculating a moving average of a stock is to help smooth out the price data over a specific period of time by creating constantly updated average prices. So that's what it does. All right, it calculates the average price over a specific period of time by creating constantly updated average prices for us to view. And depending on the average price, the period of time that you use, which can be like a 15 or a 10 or an 8, I'm going to show you which period of time for the moving average that I use to help make my decisions when it comes to trading. There's a lot of different moving averages that you can use. There's a simple moving average, there's an exponential moving averages, there's different type of moving averages too. So the main two simple moving averages that you probably going to use, that I use, they're the main ones, are the simple moving average, which is the SMA, and the exponential moving average, which is the MA, which is the EMA. They are both moving averages One is simple and one is exponential. And I will show you the differences between the simple and the exponential moving average right now. So the simple moving average is the SMA is calculated by taking the arithmetic means of giving sets a price over a specific number of days in the past, for example, over the previous 15 days, 30 days, 100 days, or 200 days. Depending on if you're trading Forex or stocks, if you're trading stocks, people probably use 100 or 50 or 200 days. If you're trading Forex, what we trade Forex, then we're going to use 15, 10, some people use 14 and 8. All right, so, and that's also for the EMA. We also use 15, 12, 8, or 10. I'm going to show you which ones I use after I explain the definition of this. So exponential moving average is the EMA. It is the weight average that is given greater importance. It's a greater importance because the price on the stock is more recent days. The simple MAA is the price overall over the last past days, over the last 15, 30, 120 days, 200 days. And the exponential moving average weight difference is greater importance because the price is more on the recent days, making it an indicator that is more responsive to new information. So we'll also explain that in more detail. So understanding a moving average. Moving average is simple technical analyst tool. Moving average are usually calculated to identify the trend direction of a stock or to determine its support and resistance levels. It is a trend following or a lagging indicator because it's based on past price. So these indicators are not always 100%, but they are accurate. Especially if you set your indicators up right, and I'm gonna show you how to set your moving average indicator up right, because sometimes it does lag. It lags a little bit. Both SMA and EMA, they both have their downfalls, and they both have their strengths. Okay, but we use the moving average to identify the trend direction and to identify the support and resistance levels. Okay. Also based off of price action. Let me teach y'all about price action. The longer time period for moving average is greater. It's a greater lag. It's a greater lag. So for the 200 day, the moving average will have a much greater lag than a 20-day moving average because that's 200. Because it's constant. Because it contains for the price past of 200 days. The 50-day and the 200-day moving average figures are for stocks that are widely followed by investors and traders that are considered to be important trading signals. So stocks people use like the 50-day and 200-day moving average. I don't really trade stocks right now, but eventually we're going to get into stocks later on. But we trade Forex, we trade pairs and stuff. So our MAA will be way closer. It's going to be like 15, 10, 8. So moving average are totally customizable indicators. I'm going to show you how to customize them. Which means that so you can find out which best one fits for you, which means that the investors can freely choose whatever time frame they want when calculating an average. The moving average, the most common time periods used in a moving average are 15, 20, 30, 50, 100, and 200 days. The shorter time span used to create that average is more sensitive because it has to do with price changing right then. So the shorter time span moving average are way more sensitive and way more accurate. So the longer time spans are less sensitive than the average will be because the larger time frame, and those are usually used for like stocks, investors and stocks and stuff. So investors may choose different types periods of varying lengths to calculate moving averages based on trading objectives. Shorter moving averages are typically used for short-term trading, while longer-term moving averages are suited for long-term traders and long-term investors. There are no correct time frames to use when setting up your moving average. The best way to figure out which one works best for you is to experiment with a number of different time periods until you find which one fits your strategy. I'll show you which one fit my strategy right after this. Predicting trends in stock market is no simple process. While it's impossible to predict the future movements of a stock or a specific pair. It's impossible to predict the movements But using technical analysts and studying and research and looking at the news and tradingview.com, looking at the news, looking at trading ideas for the day, can help you make a better prediction. But these, nothing, we can't predict the future. The market can do whatever we want, but we use these indicators. We use the news, trend line, moving average, RSI, all these things, candlestick formation, double candlestick formation, triple stick candlestick formation. We use all these to come up and so we can make a better prediction about our trades, so we can capitalize and profit and make the most money off of each trade. So it's very important, that we use these indicators because they help us make better decisions. So a rising average indicates that a security is an uptrend. So you see a moving average rising up in the market, you see it's usually going to be a red line. Some people use different line colors. Mine is red. If you see the red line, it's the moving average is a red line. I can show you it too. So fast. Okay. My chart. All right. This one probably is a little difficult for you guys to understand. This one. Let me see this one. Same thing with this one. Hold on. Just make a new account real fast. Open up a new account. You just type in Hugo Way. Mine is already up there. Just put the regular information in, and put it at like 3,000 because it's like normal. Then press done. Alright, so this is my demo account that I just created. Hold on. It's right here. Click on it. Edit it. This is a trade I had open. As you can see, I had a lot of trades open in this one. And yeah, I'm gonna teach y'all how to see this. A dollar, $952. You can make off $1.50, 460. And this is like and this has been over a couple of days. I'm gonna show you how to day trade and stuff like that. This is more like advanced sessions. I wanted just to show you my moving average. Okay. Here goes 3,000. I just created. So the moving average will be a red line. Hold on, I don't know why it's not a red line. Let me just go to moving average and just delete this. Okay. Boom. And default settings. Also, so it's set default settings as a set default settings is the 10 period time frames. That's a simple. And it's a close. I'm gonna show you. At the end of the video, I'm gonna show you exactly what that means. So when the red line is going up, is going up, and when the red line is going down, is going down. So you can see the red line is going down with the trend. But when the red line goes up, this is how we are able to identify the trend. Also, it's by just watching the red line and seeing which way it's going up. If it goes up, it's most likely going up. But we have to also look at the candlestick pattern. It's a bullish candlestick pattern. Right now, it's consolidating really, but it's starting to go back up for the gold. But besides that, that's the note. I wanted to show you the line and how the line is rising up. When the line is rising up, when you see the moving average line rising up, it indicates that the security is in an uptrend, while declining moving average indicates that it is in a downtrend. Now you also have to look at the day. You have to look at the day chart and the day chart and the weekly chart to understand if. So you can see it going up on a 1 minute or a 5 minute, and like, okay, it's going up. It's about to go all the way back up. Like, okay, cool, it's gonna go all the way up, right? But then you can go to the day chart and it's going down, or the weekly, and so you have to look at the weekly. Like, okay, for the weekly it's going up, for the day it was going down. So it's going to go back up. You can see the line is above you can see that the red line wants to go up. So when you see the red line going up, it's going up. And when you see the red line going down, it's going down. But you have to look at the day chart and the 4 hour and the weekly chart to also see which what's the overall trend. The overall trend is going up, and the overall trend for the day and the weekly is going up. And you look on it, and you go to the 1 minute or the 5 minute or the 15 minute, and you think it's going down, and then you lose all your money, and then it just goes back up. It's because for the overall day, for the 4 hours, for the last 4 hours, for the overall day, for the whole week, it was going up. But you were just seeing that, on the 15, because we do scale down to the 15-minute chart to get in trades and to make our trades in the 5-minute chart. And but we look at the overall to gain that trade. We have to look at the overall trend. So we have to look at the 4 hours. We have to look at the daily. We have to look at the weekly. So that's no. I had to say that, add that in there, because that could be tricky to new traders and stuff. And reading my notes and stuff and everything. I want y'all to know everything, all the mistakes I made. And trust me, I made a mistake by thinking that, just by looking at the moving average, indicating, even though it indicates that it's going up, oh, it's an uptrend. I have to look at the daily and the weekly to see if it's actually going up. If it's the actual uptrend. If it's making a bullish candlestick, or if it's not making a bullish candlestick. So we have to look at the bullish means going up. It's going to make a full candlestick on the day. Make a bullish candlestick. So you have to look at the day and the monthly chart to see that. So a moving average indicates that, if the moving average is going up, it indicates that it's an uptrend, and the moving average is declining, it indicates that it's a downtrend. So simply, upward momentum is confirmed with a bullish crossover. So I'll show you how to do crossovers and bullish crossovers and stuff, like with the moving averages, which occurs when a short-term moving average crossover above a long-term moving average. Conversely, downward momentum is confirmed when a bearish crossover, which occurs over a short-term moving average, crosses below a longer-term moving average. So I can show you that right now. Might as well. Those was the other lines that y'all seen in my chart. Like, got my live chart. Let's just go to my live chart. This is one of my live ones. Alright, so for this, you go to moving average. Alright, so it's basically showing y'all how to do the moving average for a crossover, because this is like, I'm gonna show y'all like what's going on in a second. So you go to the F sign, and you press the F plus sign, and you go to moving average, and that one we're gonna put exponential. We're gonna put it at 8. Right. So we're gonna change the color for this. For the second one, and we're gonna change it to so that's displaying the crossover. So crossover, this is how I learned the crossover and what they're talking about in this example real fast. I'll show you what they're talking about. How I learned the crossover is the exponential. Both of them will be exponential. I'm going to show y'all the simple moving average too. I'll also use the simple moving average, which I play around with it. It's all types of different moving averages, and you can use it once you get comfortable with what's going on. You can make your own decisions to decide which moving average fits for you. So hold on. The first one will have to be 8. First one will have to be 8. 8 for the moving average, and the second one will have to be 14. This is for exponential. Exponential, and you'll understand why I did this real fast. Why exponential is way better than SMA, and I'm gonna tell you that why. To me personally, it's a little more better than the EMA moving average is a little more better than SMA, than a simple moving average. But this is a crossover, so let's show you a crossover real fast so you can understand. Did I do that right? This one is 8, okay, and this one is 14. Alright, cool. I'll show you what this means. I can just zoom out real fast. On my phone. Not letting me zoom out. All this means, let me see. Okay, I just log out of it and then zoom back in. I had to explain this crossover so y'all can understand it. Some people use it. I don't really use crossovers or nothing. I just grab my one moving average and I go off of that. Sometimes I am using crossovers though too, cause I do like crossovers. So this is a crossover. Your EMA has to be at 8. The other one has to be at 14. The first one has to be at 8. The second one has to be at 14. So this is how you look at a crossover. It tells you the direction of a trend, kinda. So when you see the red cross over the blue, it's going down, right? And when you see the see it's going down, but when you see the blue, okay, so the crossover, every time you see a crossover, it's a change in direction. That's basically what it means. So every time as you can see, boom, here, the red crossover the blue changes direction. It's going up now. Boom, then the red crossover blue again, changing direction, it's going down. As you can see, it's just another way to like look at it when it comes, like people like to see, oh, they like when it crosses over, when the red crosses over the blue, a different trend direction. You know, it's a different trend direction. So that's how some people look at it. But that's all really a crossover is. It's just when the red crosses over the blue, it's a change of direction. Anytime you see the red cross over the blue, it's a new change of direction. So, boom, right here, the red cross over the blue is going back up, new change of direction. So we'll look for that. So a crossover is which occurs when a short-term moving average is crossed over by a long-term moving average. Constantly, if it's crossed over on a downward momentum, confirms a bearish crossover, and it's crossover on a long-term momentum is considered a long-term moving average. So when calculating moving average are useful in their own right, I'm going to show y'all my moving averages. That was just a crossover moving average. So to calculate also form the basis for other technical analyst indicators such as moving average, conversion, divergence, and it's the MACD. MACD, the factor is calculated by subtracting 26 days to the exponential by the average moving average. So it's like kind of like the crossover moving average, where it's a short-term moving average. You know, crossover is the long-term moving average. Depending on which direction, it'll let you know in which the momentum, like which direction the momentum is going in. Let you know if it's a short-term moving average, or it's a downward trend or upward trend. That really all what like that really is. The type of moving got the simple moving average. Simple moving average is known as SMA. SMA is calculated by taking the overall, giving value of the overall, like calculating the overall like given value of price and a set of numbers of price in case of a financial instrument. Add them all together and divide them by the number of prices and set. They do this all for you, so you don't have to do none of this. You don't have to know none of this, but I want y'all to know everything in detail. So they divide the number of price and set. The formula for calculating a simple moving average of security is the follows. So it's A1 plus A2 plus AN over N. The average is the A1 will be the average price, the average period over time, divided by a number of time periods. And that's how you come up with the SMA. The exponential moving average is a type of moving average that gives you more specific a more specific time frame of recent price in an attempt to make it more responsive to new information. So it's more recent, it's more recent, and it's like, it's new information. It's more responsive to like what's going on actually in the trade right now. So to calculate an EMA, you must first compute the simple moving average SMA over a particular time period. Next, you must calculate the moving average EMA to follow a moving factor, which typically follows a formula. You multiply it, and you use this moving factor combined with the previous EMA to arrive at current values. And the EMA does give you a higher weight of recent price, while SMA assigns equal weighting to all values. So EMA is gives you what's the difference, right, between the EMA and the SMA. So to calculate the EMA is more emphasis on recent data price. It gives you more like it gives you is more recent on data price and what's going on as far as like the data points and stuff. It gives you it's more recent. So that's why EMA is better than SMA. But they both have their weak points and stuff. I'm gonna show you all that in a second. Because this is an EMA, it's considered of a weight average calculation. If you figure below the number of times the EMA is identified, it's more quickly to change the price of the SMA. So the EMA is more quickly to change prices than the SMA. That's one of the advantages to the EMA. It's just quicker. It's quicker than the SMA. So that you can also observe the figure of the EMA as a higher value than the price. It rises faster in price than the SMA. Because the SMA, it like it's responsive. It's kind of like slow. It lags. The SMA it lags a lot. That's why a lot of traders like to use the EMA. But the EMA, I'm gonna show you like the downfalls of the using the EMA. You might want to use the SMA and the EMA. Sometimes I use the SMA and I use the EMA. Like on some of my charts that I got, I use the SMA and the EMA because it's better to both have both of them up there. If you ask me, because one lags, but one also the EMA also like just because it doesn't lag and it like the EMA rises higher than the SMA and it's faster than the SMA in price. When the price is declining and when it's rising, it's responsive to price changes. And the amazing reason why some traders prefer to use the EMA over the SMA. So a lot of traders you prefer to use the EMA over the SMA moving average because the EMA moving average is faster, it's way faster, and the SMA can like a lag, so it could like you can miss out on trades and stuff like that because the SMA wants to lag. So the EMA quicker. So EMA. All right, these are so for the SMA on TraderView, on MetaTrader app, yeah, it's a set default for simple SMA at 10 days moving average. So the 10-day moving average is the last 10 days to the first data point, and then after that it makes it starts over and goes from 11 to 21. So examples of moving average indicators. These are Bollinger Bands, all types of moving average indicators. You don't really have to know about Bollinger Bands and stuff, but we are gonna go over it and stuff. I just want to get y'all what y'all need to know. Y'all need to know about moving average, RSI, trend line. Now that y'all know everything else about trading, all the basics, these are the next steps. So what is a moving average? Moving average is a statistic that captures the average change in a data series over time. So it captures the data series over time. That red line captures the data series over time for the last 10 days. On MetaTrader 4, it captures the last 10 days as that's the set default 10. But it lags. The SMA lags. So like some people know that, some people don't know the SMA lag. They're just saying, okay, it's just a line. No, the moving average, you want to make sure that you pick the right moving average, that you customize the right moving average for you. Like I say, the EMA is faster than the SMA. It allows you to get in trades faster, but you gotta also watch out for the EMA. Because the EMA, just because it lets you in faster, it can also backfire on you because you think that it's going just because it lets you identify the trends faster. It can also cause a lot of fake outs and cause you to like get in trades that it's not going in that direction just because you got an EMA moving average because it's faster than the SMA. But the SMA allows, even though it lags, it allows you to avoid those some fake outs and those mistakes that you would have probably did if you used the EMA because the EMA is faster. So it's like, okay, I already identified the trend, but it could be a fake out, which with the SMA is going to, just because it's like it's lagging a little slower, it's going to be able to pick that up. It's going to be able to pick that data up, and it's going to stop. It's going to help you, so it might actually save you. So that's why it's important to use both of them. But moving average is a statistic series over time in finances. Moving averages are often used by technical analysts to keep track of prices trends for specific securities. A upward trend is a moving average might signify a upswing in the price momentum of security, while a downward trend would be seen as a sign of decline. Today, there are wide ranges of moving averages to choose from, ranging from simple measure moving averages to EMA moving averages. What are moving averages used for? Moving averages are widely used for investing that seek to understand and profit from price momentum patterns and security insights. Moving averages to detect whether a change in momentum is occurring for security, such as if there is a sudden downward move in the security price. Over time, people use moving average to confirm their suspicion that a change might be underway. For example, if the company shares price rises above 200-day moving average, it might be taken as a bullish signal. So these are some examples of a moving average. Many types of different moving averages have been developed for investing. For example, the exponential moving average is a type of moving average that gives you more weight to more recent dating trades or trading days. This type of moving average might be more useful for short-term, long-term historical data might be less relevant. A simple moving average, on the other hand, is calculated by the average series of prices while giving equal weight to each of the price involved. So that's the moving average. One more article I want to talk to you about moving average on babypips.com. Right. Shout out to my mentor, Slide Academy. So there are many types of moving averages. The most two common types of simple moving average and the exponential average are simple forms of moving averages, but they are susceptible to spikes. Exponential moving averages put more weight to recent price, which means that they more emphasis on what traders are doing now. So one is allows you not to. It's simple, so it avoids spikes. And the second one, it gives you allows you the exponential moving average is for what's going on right now. So it's much more important to know what traders are doing now than to see what they did last week. Average smoother than the exponential moving average, because the longer moving average are smoother than the shorter period moving averages. But however, using the exponential moving average can help you spot a trend faster. It can help you spot a trend faster, but it's prone to many fake outs. Okay, it's prone to many fake outs. Remember, I was going to show y'all what's the difference between with the pros and cons of using both exponential moving averages. Yes, it allows you to identify the trend faster. Yes, it allows you to identify the trend faster. So it allows you to identify, and get in a trade faster. But it can also backfire and cause you to have many fake outs because exponential, it has a lot of fake outs. It's prone to many fake outs. Simple moving averages are slower to respond. They are slower. They're slower to price action. They're slower to respond. But they save you from fake outs. They save you from spikes. That's why I say it's better that you use both of them. So you put them both together so you can't lose. However, because there is a slow reaction, they can delay you from taking a trade that may cause you to miss out on opportunities. That's why I just use both sometimes, because one's prone to many fake outs and the other one can save you from spikes and fake outs. But however, the SMA is slow to reaction. It can delay and cause you to delay you from taking a trade that may cause you to miss out on some good opportunities. So you can use moving averages to help you define a trend, when to enter and when the trend is coming to an end. What moving averages are for. So moving averages can be used as a dynamic support and resistance level. One of the best ways to use moving averages, plot different types of moving averages, so you can see the both long-term momentum movement and the short-term movement. So plot different ones on there, play around with them. At the end of the video, I'm gonna show you which moving averages I use. Alright, gang. So you got all that. So why don't you open your charting software and try popping up some moving averages? Remember, using moving averages are simple. The hard part is determining which one to use. That's why you should try them out and figure out which is best for you, best for your style of trading. Maybe you prefer a trend following system, or maybe you want to use a dynamic support and resistance system, whatever you choose to do, make sure you read up and do some testing to see how it fits your overall training plan. So, alright, okay, now to wrap this video up. Alright, so for the moving average for me, I do use the exponential moving average. Okay, I'll have an exponential moving average. You go to the F sign and you type in moving average, my exponential moving average, because I will have it at 8. My mentor told me to put it at 8, so I have it at 8. And the second one will be at 14. Okay, and I will keep both of them. And I don't really use the SMA. I used to use the SMA. Sometimes I don't. That's one of my setups. Okay, that's like one of my setups to do. Would be, it is all different ones. You know, you can decide which one fits, which one works for you. Alright, so another setup would be, this is the normal setup, would be a 10. It's a simple moving average. Remember, when the red line is up, it's going up. When the red line is going down, it's going down. This is how you see it when you first go into MetaTrader. It's going to be a regular moving average. It's going to be set as simple. You can change the method to exponential. They go smooth and linear weight. We don't really mess with them too. You can trade, these are the two most common ones. So you can trade it to exponential, but when you go to set default, this is what it is. It's that 10 period. Every 10 days, every 10 period, it gives you the simple moving average and balance. You know, it's pretty solid. I can make a lot of money using this moving average. People make a lot of money using this moving average. I did make money off of this moving average before, but it lags. So what I would do is I will keep that. You know, because I might even put it at 8. You know, the 10's cool. I will create another one, right? Another moving average. Boom. And click the plus sign, moving average, and I will put it at exponential, and I will put it at 8, and I will change it to blue, right? I'll change it to blue. This way, alright, my first exponential is at 8, the simple one, I got the simple on there. That exponential for 8 is just to let me know, you know, because it's faster. You need an EMA on there. It's the fastest one, the fastest moving averages that you can use. And 8 is what my mentor uses, so I use 8. And I got the default one on there too. Sometimes people only use 1 because 1 is better on your eyes and stuff like that. But you can play around with it. Like I said, the default one, a simple moving average. So it's going to, you know, prevent fake outs and prone to fake outs and stuff. But it's slower, so you can miss out on trades and stuff like that. So it's up to you. For me, I will use the exponential. I might switch, or I might just do this. I might just delete this by holding it down, and I will just have one moving average. Right, I'll put it at 8, and I'll put it at exponential. Right, I'll have an EMA moving average, and the, you know, color's red. And how you read a moving average is when the candlesticks are above the red line, it's going up. That's true. And when the candlestick is below the red line, it's going down. So that's true. See how the candlesticks are below the red line? It's going down. That's how you identify the trend. So when you see and also trend reversals too, because it's going down, but then it reversed. And once that candlestick got above that red line, it's a reversal, meaning it's going up. So how you identify the trend on using the moving averages, what we use. So this is the next step right here. Is moving averages, trend lines, RSI, which is right here. RSI, when it's at 70, it's going up, and when it goes down to 30, it's going down. So I go a little more, so that's pretty much